3224, Introduction to Managerial Accounting. This video will cover chapters 1 and 2. I am Harjinder, the instructor for this course. This video will hope to achieve the following learning objectives. After watching this video, you should be able to define what managerial accounting is about and distinguish it from financial accounting. Should be able to describe the role of a management accountant within an organization, explain the importance of ethics in the context of accounting generally and management accounting specifically, identify the various cost categories that are used in management accounting, learn how to prepare a schedule of cost of goods manufactured, and an income statement for a manufacturing company. So let's first look at management accounting and the business environment. So managerial accounting, also called management accounting, is concerned with providing information to managers or decision makers so that they can use that information in planning and controlling operations of the organization and for making decisions about what to do in the future. So management accountants must possess competencies in cost management, in performance measurement, both financial and non-financial, process management, and risk management. And it's very often the case that management accountants end up playing a key role in decision making across various functional areas of an organization. Accountants, whether they are financial or managerial accountants, they tend to occupy staff positions in most corporations. In most large Canadian companies, the top accounting position is that of a controller who reports to the CFO or the Chief Financial Officer. Next, let's look at the difference between managerial accounting and financial accounting. Note that accounting in general involves recording, estimating, organizing, and summarizing of financial and operational data. Now you notice on the screen that financial accounting has an arrow facing to the left, whereas managerial accounting has an arrow facing to the right. Now that's following conventions in the Western world that the right facing arrow is supposed to indicate looking into the future. The left facing arrow is supposed to indicate looking back into the past. And that's how I'm going to try to present the differences between financial accounting and managerial accounting. So with regards to financial accounting, the purpose of financial accounting is to report the financial performance and financial position of an organization to users who reside outside of the organization. So that could involve owners, so shareholders of a company, creditors such as banks or other lenders, tax authorities such as Canada Revenue Agency, and regulators. So that would include securities administrators such as the Ontario Securities Commission. In contrast, Managerial accounting's role is to report to folks inside the organization, so people that are charged with managing the company and those who are also charged with governance, such as the board of directors of the company, so that they can use the information for purposes of planning, directing and motivating employees, controlling the operations, and for evaluating the performance of managers. Another difference is that whereas financial accounting emphasizes the consequences in financial terms of activities that have occurred in the past for an organization, the emphasis in managerial accounting is to provide information that'll help make good decisions that'll have an impact in the future. Another difference is that financial accounting tends to emphasize objectivity and verifiability, that the numbers that are reported should be capable of being verified by auditors. In contrast, the focus for managerial accounting, the emphasis for management accountants tends to be that on relevance, provide information that will help make a good decision in a timely manner. And that brings us to the next bit of difference. Whereas financial accounting tends to emphasize precision or correctness of the information, management accountants emphasize timeliness, and they're happy to make use of a lot more estimates than financial accountants would be in sharing with outsiders. Another area of difference is financial accounting tends to emphasize data that's summarized and classified, and you need to condense all the information pertaining to to typically companies that could have operations in the magnitude of billions of dollars worth in a year into a set of financial statements that span maybe 4 or 5 pages. So there's a great deal of summarization that occurs concerning the entire organization. In contrast, management accounting tends to be a lot more granular, a lot more detailed, and it includes segment reports about specific departments or products, or even to the level of customers. Financial accounting must follow generally accepted accounting principles. In contrast, there are no generally accepted accounting principles that apply to the world of management accounting. The final bit of difference is financial accounting is mandatory for external reporting. You need the work of financial accountants to compile the set of financial statements that have to be included in the annual report of a company. Management accounting, on the other hand, is not mandatory, but it would be foolhardy for a company not to make use of the work of a management accountant. To sum up, financial accounting tends to be oriented towards the past. It reports the outcomes of past performance, whereas management accounting is more future oriented, and its objective is to provide information to managers and key decision makers within the organization so that they are able to better run the company, run it more effectively and efficiently. A little word on ethics. It is important for companies to be concerned about their ethical reputation. If a company is not trusted by its customers, its employees, and suppliers, it'll eventually suffer. In the long run, the very survival of the company may depend on the level of trust that its stakeholders have in the organization. So what do organizations do? They usually end up preparing a code of ethics, which is written, it's documented to reflect their values and moral system. And this document, it specifies what's expected of its employees, the organization's employees, when they're dealing with various stakeholders. Who are stakeholders? These are individuals or organizations who have an interest in the company's activities. So examples would include not only shareholders and creditors, but also employees, customers, suppliers, or even the communities in which the organization operates. So the code of ethics must reflect what the organization stands for when it interacts through its employees with other stakeholders. Organizations, companies have a system, a mechanism for achieving oversight over the organization's activities. And this entire system is called corporate governance. So corporate governance is achieved through the company having an elected board of directors who play a key role in ensuring effective corporate governance. There are legal regulations such as the Sarbanes-Oxley Act in the United States that lay down rules for corporate governance. The board of directors, they help provide direction and control for the over the company's activities through its various subcommittees. There's also over time an increased awareness and interest in the concept of CSR, or corporate social responsibility, which refers to the idea that companies should consider the needs of all stakeholders and not just their shareholders when making decisions that are related to the business. Okay, next up, we're going to look at cost terms, concepts, and classifications. First up, major cost classifications. These would include product work costs versus period costs, variable costs and fixed costs. There's also a concept of mixed costs, about which we will learn in a later lesson. Direct costs and indirect costs, and differential costs, sunk costs, and opportunity costs. So a closer look, why would we bother with cost classifications? So one reason could be that we intend on preparing financial statements for a release to external parties. If that is the case, it is important for us to determine which costs must be expensed during the period and what costs can be inventoried or added to the cost of the products that the company sells. If a cost is classified as a product cost, then it is not expensed when incurred, but rather when the cost is incurred initially, the cost is added to the cost of inventory. And later on, when the products are sold to customers, at that point in time, we expense those costs in the form of cost of goods sold. So the subcategorizations of product costs include direct materials, direct labor, and manufacturing overhead. We are going to learn a lot more about these concepts later. The period costs are any costs that are non-manufacturing in nature, and these are usually grouped under marketing or selling costs and administrative costs. And the key point to remember here is if a cost is a period cost, it must be expensed when the cost is incurred. Another purpose for classifying costs may be in predicting how costs would behave in response to changes in production levels or activity levels. So if you've taken a course in microeconomics, you may remember that some costs vary proportional to activity levels or production levels, and these are called variable costs. So what ends up happening in that case is the total cost would increase as the production volume increases, and the total cost would decrease when total production decreases. There are also costs that are fixed in nature, i.e. they don't change in response to changes in production levels. So an example of that could be the rent you pay for the factory building. If the lease is standard negotiated, then every month the rent that is paid for the factory building will not change in response to how much production is conducted in any given month. Another purpose for cost classification might be so that we are trying to assign costs to something called a cost object, which could be an individual product, or it could be something at a departmental level. Now, if that were the case, if we were looking to assign costs, then the classification essentially is driven by whether the cost can be easily traced to the cost object or not. If it is possible to trace the cost to the cost object very easily, then we would call it a direct cost. If it's not possible to trace the cost back to the cost object, then we would call this an indirect cost. And at this point in time, I would advise you not to get overly anxious if you do not fully understand the meaning of these terms. You're just getting familiar, we're just getting our feet wet. We will be spending more time and effort in trying to understand the specific meanings later on. Finally, if the intention behind the cost classification was to make decisions, decisions are often better supported or guided if we were to classify the costs in terms of a differential cost, a cost that would actually differ between competing alternatives, a sunk cost that can be ignored because it is not going to be impacted by the decision to do either A or B, and an opportunity cost, which would be the cost of the benefit that we would give up if we choose a particular alternative. Again, these are concepts that you may have learned in a microeconomics course. If not, we will at a later stage be coming back to these concepts. Moving on, a closer look at product costs versus period costs. Product costs are also called manufacturing costs, and essentially they include three kinds of costs: direct materials, direct labor, and manufacturing overhead. Now, when these costs are incurred by a company, they're not recorded as an expense, but rather they are debited to the cost of inventory when they are incurred. And later on, when the inventory is sold, the cost is expensed in the form of cost of goods sold. You may remember that term from Accounting 2121. Period costs, on the other hand, are non-manufacturing costs, and they generally are grouped in two categories: marketing and selling costs and general administrative costs. These non-manufacturing costs are expensed when they are incurred. So big difference. Period costs are non-manufacturing costs, which are expensed when the cost is incurred. In contrast, product costs are manufacturing costs. They are not expensed when first incurred. Rather, we debit them to some kind of an inventory account. And later on, when the inventory is sold to end customers, that's when we record the expense in the form of cost of goods sold. Closer look between the product and period costs. Product costs, another term for product costs is inventoriable costs, costs that can be added to the cost of inventory. These are costs that are related to the manufacture of goods, include DM, direct materials, DL, direct labor, and MOH, or manufacturing overhead. When incurred, they are added to inventory. So these costs will be carried on the balance sheet in the form of inventory until the goods are sold. When that happens, they are expensed as cost of goods sold. Now, for a manufacturing company, depending on the stage of completion of the manufacturing process, these product costs can exist in the form of raw materials, work in process, and finished goods. So raw materials, I think it's fairly simple to understand. So if you make furniture out of wood, the lumber is raw materials. Finished goods, on the other hand, would be the furniture that is ready, packed to be shipped out to the customers. Work in process refers to once work has started on the lumber, it's been cut, and it's it's being worked on, but the manufacturing is not completed yet. So the stage between raw materials and finished goods is referred to as work in process. Period costs, on the other hand, are expense. They are not included in product costs, and they essentially relate to either the marketing and selling activity or the general administrative activity. They are expensed when incurred. So the result is that these costs are recorded as expenses on the income statement under operating expenses as they are incurred. A closer look on manufacturing costs. Recall, manufacturing costs can be direct materials, direct labor, and manufacturing overhead. So first off, what's direct materials? So the definition here would be direct materials are those materials that become an integral part of a finished product and can be easily traced to the finished product. So an example might be, a seat on an airplane, and depending on the size and nature of the airplane, it may have X number of seats. So each seat is very much capable of being traced to an individual aircraft. The concept of direct materials differs from something called indirect materials. So indirect materials are raw materials that cannot be easily traced back to a finished product. So if you think about the airplane seat that I mentioned, the seat possibly needs some screws to be attached. There's some glue that's needed. Those are consumables. Now it may be possible, like one could argue, a seat will have probably 8 screws, and there's a certain amount of glue that is usually applied to affix the leather or the upholstery on the seat and so on. But quite frankly, if it would take too much effort to try to trace exactly how much of such consumables like screws and glue or thread and is necessary, it's possibly quite possible that the benefits from tracing are far outweighed by the costs of doing so, and hence companies will usually not bother. So it's not that it can't be done, it's just that it's not cost beneficial to trace such costs back to an individual product. Hence, raw materials that are not easily traceable back to a single unit of product are lumped into what's called indirect materials. So indirect materials are included in something called manufacturing overhead. Okay, so next up you have direct labor. Direct labor is the labor costs incurred inside a factory that can be easily traced to a finished product. So it's basically touch labor, people, the cost of wages paid to workers, assembly line workers that actually helped create the product. So an example might be the assembly line workers in an automotive manufacturing plant. Now, it's important to keep in mind that direct labor is different from indirect, because you could have people that work at a factory. So think about janitors, material handlers, security personnel, and so on. Now, the work that they do is important, but it's very difficult for us to uh, trace back exactly how much of the janitor's work was necessary to the production of a single unit of product, right? So there, such kind of labor that's necessary for the manufacturing facility, but can't be easily traced back to a single unit of product, is called indirect labor. And indirect labor, just like indirect materials, is added to manufacturing overhead. Now, it's important to keep in mind that indirect labor also includes cost of idle time and overtime premiums. If a company pays overtime, usually companies would pay overtime at time and a half or twice the basic direct labor rate. So if the overtime or idle time is not related to a specific job, then such overtime is added to manufacturing overhead in the form of indirect labor. Okay, so we've looked at direct materials, we've looked at direct labor. Third, under manufacturing costs is manufacturing overhead. So this is sort of a catch-all term intended to include any kind of manufacturing related cost. So be it indirect materials, indirect labor, any other manufacturing cost that is not already captured as direct material and direct labor. So some other examples might be the cost of factory maintenance, the insurance of manufacturing equipment, heating and lighting costs inside the manufacturing facility, the factory, property taxes, insurance, depreciation related to the factory. They will all be part of manufacturing overhead. It is important to keep in mind that depreciation, property taxes, insurance may also be incurred for the company's headquarter building, let's say. Now, if there is no actual manufacturing taking place in the general administrative building, then those costs will be seen as administrative costs or marketing and selling costs, depending on the nature. So any kind of non-manufacturing costs, you must keep in mind, are considered period costs, and they are usually classified either as marketing and selling costs or administrative costs. And some examples here might be advertising, sales salaries, accounting and secretarial costs, HR salaries, so on. Okay, so just to wrap up then, manufacturing costs, they're also called product costs or inventoriable costs. They belong into three subcategories: direct materials, direct labor, and manufacturing overhead. So With regard to direct materials, these are materials that can be traced to a product. So example, wood, the amount of lumber needed to build a table. Direct labor is the cost of labor that can be traced back to a product. This includes the assembly line workers in a manufacturing plant. And very often, direct labor is also called touch labor. People that make things actually touch the things they make, right? And you have manufacturing overhead, which is basically all manufacturing costs that are not captured in direct materials and direct labor. And it would include stuff like indirect materials, indirect labor, utilities at the factory, depreciation of factory buildings and equipment, and so on. Now, your textbook also talks about a couple of other related concepts. There is the concept of prime cost, and there's the concept of conversion cost. So when we refer to prime cost is nothing but the sum of direct materials and direct labor. So if you add together direct materials and direct labor, you get prime cost. Conversion cost, on the other hand, is the cost incurred to convert direct materials into the finished good. So what do we need to add to direct materials? We need direct labor and manufacturing overhead. If you were to add direct labor and manufacturing overhead together, you get conversion costs. So once again, prime cost is the cost of direct materials and the cost of direct labor added together. Conversion cost is the cost of direct labor and manufacturing overhead added together. Non-manufacturing costs are also called period costs. They are categorized in two sets, either marketing or selling costs, which are all costs that are needed to get orders from customers and to get the finished goods or service over to the customer. So these would include stuff like advertising, commissions paid to salespeople, depreciation of the delivery equipment, the cost of renting a warehouse, if you will. These would all be seen as marketing or selling costs. And administrative costs are basically all other costs to run the company in general. So this would include stuff like research and development, depreciation of general office buildings, equipment, the compensation paid to executives, salaries paid to non-manufacturing staff, and so on. So here's a look at an example taken from the textbook. This is exercise 2-1. And we're given some costs that are related to a company called Sounds Good, which makes high-end audio equipment. The company owns its manufacturing facilities, but rents the space used by non-manufacturing employees. And what we're required to do is classify or identify which of the following costs, there's 10 cost items given, which of them would be classified as direct labor, direct material, manufacturing overhead, marketing and selling costs, or administrative costs. So first of all, we have depreciation, taxes, and insurance on manufacturing facilities. So any cost related to the manufacturing facilities will be product costs, right? They'll be part of manufacturing costs. Now, if we look at these costs, depreciation, taxes, insurance, they're certainly not direct materials nor direct labor. So these would be classified as manufacturing overhead, or MOH. The rent on the office space that is used by non-manufacturing staff, the key giveaway is non-manufacturing. If it's non-manufacturing, then it is a period cost. Now, period cost could be either selling and marketing related or general administrative. Here, it's not clear who the office space is used by. So if it's not clear, go with administrative. These are administrative costs. Number 3 speaks of salaries paid to employees who produce the audio equipment. So clearly, these are employees who actually make the audio equipment. So that's direct labor, or DL. The cost of glue used to fasten the company's logo to the grill used on all of its speakers. So it is definitely a form of material. Glue is a material, it's a raw material that's used. However, I don't believe a company would want to spend a lot of energy trying to determine exactly how much glue was used to fasten the logo to the grill on the speaker. So it's materials, but you don't really want to trace the cost of this material to an individual unit of product. So this would be indirect material, and indirect material is included as manufacturing overhead. Next up, we have the cost of online advertising. Advertising costs are related to the marketing and selling activity. The salaries paid to accounting employees. Accountants are very important people, but they don't actually make the products, nor do they help in market and sell the products. Hence, salaries paid to the accounting employees belong under administrative costs. It's a period cost. Next up, we have a salary paid to the production manager who supervises the manufacturing activities for all products. So it's a manufacturing related cost. It's a salary paid to an individual, but this manager actually doesn't make the product himself or herself. He or she supervises the activities of other workers. So important person, but because they do not make the product themselves, can't be lumped under direct labor. So they are indirect labor, and indirect labor is part of manufacturing overhead. The cost of plastic used for turntable dust covers, assuming that the cost is traceable, you would put it under direct materials. If, on the other hand, you assume that the turntable dust covers, are pretty flimsy, the cost of the plastic is insignificant, and quite often the plastic covers end up tearing and may have to be sort of, you may have to actually end up using a little bit more. Well, in that case, you could have also called it manufacturing overhead, considering that the cost is indirect. I've assumed that the cost is traceable and hence direct material. Number 9, bonuses paid to sales staff for meeting their monthly sales goals. Sales staff, selling and marketing. And then lastly, salary paid to the manager of the HR department, human resources. Again, very important people, but they don't actually make things. They don't actually help sell or market them. So the salary paid to the HR manager belongs under admin costs. Okay, so at this point in time, we are going to take a break. I will continue in the next video.